The credit markets in 2026 are not for the faint-hearted. Investors are demanding consistent returns with more transparency, set against the landscape defined by volatility, which seemingly has storm clouds gathering in the distance. But what are the real themes driving the credit markets today? Joining me to explore the risks and rewards are Jerry Pascucci, co-head of Unified Global Alternatives at UBS Asset Management, and John Popp, the Global Head and Chief Investment Officer of the Credit Investments Group at UBS Asset Management. Welcome to The Red Thread, Jerry and John. John, I want to start with the big picture, and I want to ask you to describe the kind of mood right now in credit markets and how different that feels to perhaps the past.
I think the mood is actually constructive. I mean, usually when there are periods of dislocation, it creates the best opportunities, and we've seen that time and again. I mean, our platform is grounded in collateralized loan obligations. I did my first deal in 1995. It's a long time ago. But that market, for example, was completely written off coming out of '08. The popularity of that product is the highest it's ever been. The adoption of that product is the highest it's ever been. The focus now, and the press anyway, and I think among certain pockets of investing, is the private market. But even there, we've seen money move out of our traditional broadly syndicated loan mandates to go into private. I remember as a freshman putting a quote by a British author, William Blake, on my door, and it said, "The road to excess leads to the palace of wisdom, for you can never know what is enough until you've had more than enough." And we've gone through the more than enough period many, many times. And I think that's kind of what's going on right now with private credit. It grew extremely quickly. It's got to be sorted out, but it's going to be here. And in a way, it's nothing new. Companies need to borrow. The democratization of access to capital has been so critical to the growth of the U.S. economy. And I think you kind of go back to Drexel and Milken and high yield, and nobody wanted to see high yield issuers at one point, but that has driven so much growth, and I think we're just kind of going through some growing pains here.
And Jerry, we look at that kind of time horizon. You bring up, Drexel. You go back over the last 4 decades or so. How much of a change have you seen, and what do you ascribe it to?
Yeah, so a few things. Most recently, if you go back, say, 8 or 10 years, it's more structural than anything else. I agree with John. Provision of credit is what it is. Loan is not a security by definition, probably won't be. It's still all about underwriting and your attachment point, and obligors and borrowers now access different parts of the market for the supply of credit. So there's a bank market, there is a non-bank market, there is a securitized market, and sometimes facilities are shared. So the supply of credit is now rebalanced, and the structural innovations have allowed much broader, wider participation in those markets. And with that broader and wider participation comes scrutiny from both the analyst community and the journalist community. And so I would say there is today what I would consider elevated noise and potentially less signal.
And John, when you put on your tie and your suit and you go out to talk to clients today, how would you say that expectations around credit have changed over the course of even this year?
Well, the questions really have continued to be focused on the private side. I think overall, people are looking for income, aging population. There's a key driver here of wanting to see that coupon come in. It's not a capital gains product. But the broadly syndicated loan market, and I think to some degree you can look at that as a proxy for private credit, since it began being tracked back in 1992, the index has only had 3 down years, and the only big drawdown was '08. So I think that the credit continues to offer people the opportunity for a low vol, steady return. But as Jerry was talking about, it's really about the credit selection, the managers. I think people just need to be looking a little bit more closely at that. When something grows extremely quickly, and the same thing happened with CLOs early on. There were some folks that really pushed the parameters of what permissible was. So I think there's a little bit of kind of sorting through how these products are managed.
I think you have to back up to what happened in rates. And I think most people lose sight of the fact that Private credit, the term private credit is often used ubiquitously to describe direct lending, particularly over the sponsor business. And private credit, it's got a much, much broader aperture than simply direct lending. If you take the direct lending, that's squarely where the bulk of the growth has been. That happened due to the fact that structures were created and approved by the regulators that allowed for the breadth. But let's remember where we came from. We came from a world of zero interest rates, a lot of stimulus, where for most investment categories and asset classes, the world favored the lender over the owner. It was a better relative value. And there was that unavailability of yield in most places without some degree of stretch. So the environment was completely ripe for growth. It's totally understandable. Secondly, things like buyouts share a circulatory system with the debt markets. They don't exist mutually exclusively.
Right.
They don't exist in a vacuum. One is the lifeblood of the other. So it was an ideal world in many respects to be an equity investor as well. And so that credit supply lived and grew alongside that opportunity set for private equity at the time. So you would expect, if you had a rich opportunity set and you had some structural innovation and you had a desire by investors writ large, and even a need by investors writ large to achieve their financial goals by virtue of earning that yield, for that market to grow. And all the requisite pieces that were necessary to do that were put in place.
And just to come back to what John was talking about in terms of there being nothing new under the sun, and we've seen cycles go forward with new types of products again and again and again. In this context, have clients' views about transparency shifted over the last year or so, and how?
Yeah, so as I alluded to before, you have registered vehicles. They're perpetual in nature. They're evergreen type offerings. They contain many more clients of smaller size, lower eligibility. Their advice providers are the central points of distribution. They offer advice. They make very granular suitability and best interest determinations around what they offer to their clients. By virtue of the fact that many of the large lenders are public companies themselves, that offers additional disclosure and window into their activity. So you've created a very fertile ground to cause a lot of discussion. And then through more clients holding these exposures, not having faced real headwinds for some period of time, now entering an arguably new portion of the cycle, the level of questions that they have will rise, not only from investors directly, but from diligence providers, allocators, large investors, distributors, as I said before, analysts, journalists. So you would come to expect that if large exposures were accumulated in new structures over time by a new audience of investor class, that throughout the process of educating them, you would stimulate a lot of dialogue. You would expect a lot of questions.
And John, I asked you about kind of changes in the mood in the credit markets, but what about changes in interest levels across different markets, across different regions? Where are you seeing shifts when it comes to that?
I'd say where we saw the biggest shifts were post-GFC. The loan asset class had been the domain of mutual funds and CLOs. And after that, we started to see the adoption globally by institutional investors, large pension funds here, super funds in Australia. So it has become truly a global product in terms of its adoption and its place in portfolios. And I think that to some degree set the groundwork for the further step with the development of the private credit markets through the initial involvement on the broadly syndicated side. As I said to you, several of our big broadly syndicated mandates have pivoted in almost looking at our product as a cash surrogate to fund commitments to the private side. I do feel that a lot of folks went into private, including primarily on the institutional side probably, because they were comfortable with their PE exposures, no vol. You'd see lots of things move around in the GFC, but it wasn't the mark on their private equity portfolios generally. So, but what's opened it up to scrutiny now is with things that are registered. So the BDCs and other registered formats give the regulators a window into this.
And so besides those kind of bumps in the road, Jerry, as you see this constant rise, growth in private markets, how do you see their role shifting, evolving?
I think credit's a bit unique because this essence of public and private, and sometimes the security is more private than the structure is, and sometimes vice versa. And what does the word private actually mean? I think there will be a new paradigm for portfolio management that attempts to tranche risk in terms of quality. And there will be investment grade equivalent risks, there will be non-investment grade equivalent risks. Some will be delivered in securitized format, some will not be delivered in securitized format, some will be privately negotiated, some will not. Those that are may be marked, those that marked may be traded. Okay, and these are new developments, and some may be 6, 9, 12 months away before you even really meaningfully get to the starting line. But the direction of travel seems to be to try to attempt to provide some conformity. That's, in my opinion, slightly easier in a debt instrument. This all comes down to your origination, your underwriting, your attachment point, your discipline, whether or not you're susceptible in terms of the perfection of your lien or your position. Whether you do that privately negotiated or whether you don't, whether a loan is syndicated or whether it isn't. I just think that the whole model for how you think about allocating capital and whether you bifurcate simply by virtue of whether something is listed or non-listed is really not the future for risk takers.
The people that are saying this is '08, I think that is so off. And there's some pretty prominent folks that have made that statement, but what happened then is materially different, particularly around the structured product arena, where you thought you were diversified. You were basically making home loans to folks that shouldn't have had a loan to begin with, and then you were multiplying that same risk again and again and again through the synthetic market.
Yeah.
And this is, okay, you make a loan, it's good or bad, but that's the risk. It's much
or
more.
one times leverage permissible in the BDC market, which is an 8 or 30. So the gearing is important to understand.
And John, what would you say were the kind of the lessons that folks in the loan CLO space are taking from this growth, this evolution, these innovations you're seeing in other areas of private credit?
It works for corporate credit. I think that's one of the takeaways that came out of the GFC, where even though you had problems, it's a lot easier to turn around a company, sell it off in pieces. Maybe you don't get 100 cents on the dollar back than it is to deal with a bunch of loans in Florida to bad credits.
Let's keep the size in context too. Whatever you want to call private, direct lending or non-bank lending writ large, it's not a disproportionately large size of the market. So we keep talking about what the broadly syndicated market learns from the I'll call it the non-syndicated market for this purpose. This is still a very small area. Yes, it's growing rapidly. Yes, order of magnitude is large in a reasonably short period of time. As a percentage of total credit supply to an economy, that's significant.
Not systemically risky, and therefore you think the nervousness some people are expressing is overblown.
Yeah. I mean, look, there's some nuances to this, okay? We've made some very binary assumptions writ large about, hey, there's no viable borrower in software, but no one's overpaid a penny for a AI company. The real concern is on a look-through basis, to John's point that he raised regarding whether or not you were diversified or not, be it home ownership during the GFC or now. It is hard to avoid clustering of risk. It is not only an inter-credit question, it's an intra-credit question, intra-asset class question, inter-asset class question. So you're mobilizing around some very dense, very clustered themes. And you have to determine how you're going to manage that risk ex ante and whether the traditional means in which to do so are going to be as effective.
Would you agree with that, John?
I do. And I think, when you look back over the non-investment grade credit cycles, you think about other similar environments and, the dot-com bubble leading up into that, telecom, putting a bunch of cable into the ground and thinking that it was immediately good. Yellow page directory businesses were the thing for a period of time. What I see that looks a little bit similar to what we were starting to see in 06, 07 is the data center boom.
Risks can happen. And I think you have to be vigilant around your book. But to suspect that there's no winners, losers scenarios in any of these subsectors right now, I think is a bit naive.
So for folks who want to hear what you both think about this, let me ask you, you mentioned data centers. Obviously, the demand is driven significantly by AI. You've talked about that pylon into AI equities and other spaces around that as well. Do you see that as a risk, an opportunity, both? Short answer.
Both.
I agree. Yeah.
And how do you mitigate in your space when we're talking about this?
We've been trying to sort through that. We have software exposure. It's been a big part of both the high yield, but even more so the loan market. As you were alluding to, everything just fell. Everything was the same. But it's not. So the exercises that I think managers are going through is like, well, where is there real AI risk, and how does that risk manifest? And then how do we use AI? And I think one of the ways we'll use it is challenging. Here's what we're concluding. What are we missing in trying to use AI itself as a tool? It'll make things simpler for analysts to put together materials, no question. But how do you actually use it to influence the decision making?
Inevitably, however you go about that, you either have to go up in quality, down in size, or you have to introduce non-correlated exposures that reach into the breaches when the breaches open. So what I'm trying to do for an investor is give them choice to step into exposures that have various payoff profiles depending on what happens. Now, how we go about doing that is very informed by AI, will become more informed by AI. And if the dream is real, then AI will be a benefit and will be a tailwind. As it pertains to asset allocation, I struggle to not consider this a risk. Because even if the dream is real or is even more virtuous than the most virtuous case, doesn't mean it doesn't have a downside. And the more you stretch it, by definition, the more risk you have. So I can, and now when it ties back to your question around transparency. Without additional transparency and less latency around that transparency, and even predictability about winding up in a particular position, could you know that you didn't own a company in one place, that you financed in another, that was your tenant in a building, or your target to stabilize your data center development simultaneously?
Just so interconnected.
So this interconnectedness is a new risk paradigm, and it's caused by the same thing that's going to help you predict it, arguably. So where the equilibrium is, I don't know that any of us really know. But if we don't bootstrap our tools and we don't bootstrap our capabilities as underwriters, then the risk is you're slow.
Although you were asking what are clients saying, and I would say over the course of the year, the question has become less about AI in the context of how are you using it to make your portfolio investments, and more it's sort of an angst around systemic risk. Like, what is AI capable of that has nothing to do with your portfolio, but just the financial system? And that's where I think a lot of attention
And society.
Yeah.
I mean, you could take it as far as you want to go.
The dream could be real, but so too are the risks. I think we leave it there. Jerry, John, thank you so much. As we've heard, the fundamentals around credit have not deteriorated, but the market is facing significant change as it shifts from uncertainty to dispersion. There is volatility and potential risks, but at the same time, for investors with a longer horizon and the ability to be selective, there will be opportunities for genuine value. You've been listening to The Red Thread, a podcast series in partnership with custom content from the Wall Street Journal and UBS Asset Management. I've been your host, Willem Marks. Join us for more episodes at partners.wsj.com/UBS, and be sure to subscribe on Spotify and Apple Podcasts. The content in this podcast was relevant when published. Current views may differ.